Hi, I'm Keith McCullough. Welcome back to our new studio here in Stamford, Connecticut. Today I want to talk about a topic that really makes me angry. You know, you get upset about certain things in life, and this is a big one for me. It has nothing to do with, the firm that I run or the family that I live in. It has to do with this guy, this unelected central planner. His name's Ben Bernanke. And one of the biggest issues with Ben Bernanke is that he fundamentally believes that he can smooth economic gravity. So he's going to interject himself in the currency market, the bond market, the stock market, and in some, ideological world of his, he's going to develop some kind of an output, which is called economic growth. Now, of course, he's had none of that. And I would argue that throughout the year, which I'll show you in a second, what we've had is an expectation of Ben Bernanke getting out of the way. They call it tapering. That has actually been the catalyst for growth. So if you look at this first chart, you can see what this unelected central planner unilaterally decided, which is to devalue the US dollar. So on September the 18th, basically that's what the decision was. No tapering. Now you can see in this picture that he may have had a political discussion on the timing of that. Not accusing you of that, not saying that at all. But I'm saying, what is going on, man? Every single person in this market, everyone, including my mom, who's barely in the market, thought that you were going to taper. So why did you decide not to do that? That's question number one. Question number two, which is, why do you dislike a strong dollar so much? Why do you dislike that functional purchasing power in people's wallet? That thing that's creating something more than nothing in terms of real consumption growth. That's 70% of the economy, dude. This is a big, big problem for you to get in the way of American purchasing power. So that's point number one. The US dollar index is down about 5% in a straight line since he decided to make that decision, which is a huge problem. Point number two. Now, the interest rate reversal. This is a very, very bearish thing in our playbook, which is, of course, the signal that rates are falling is a signal that growth is slowing. So this guy decides, I don't want bond yields to go up anymore. Now, again, I don't know who he talked to. I know that there's a huge bond bull lobby out there that would love for interest rates to stay at 2% and bond managers get paid forever until whenever forever is. Now, that's not going to help me because me and my savings account, I have a savings account. I was taught to be frugal. I'm conservative. I have a savings account that earns zero because this guy decides that he's not going to let interest rates go up. So, at the same time, to review, we have the dollar going down, so the purchasing power of Americans is going down 5% in a straight line in 1 month, and you have interest rates falling, which is a very negative growth signal, all within the context of economic history. Now again, to take a step back is very difficult for Bernanke, and this really does make me angry, because he really misrepresents the truth. Misrepresents the truth of this economy, what makes this economy work, what kind of environments we've had, and he's really anchoring on this fear-mongering of one specific period of time, which if you go outside, you're not going to see, which is called the Great Depression. So look at this final chart that I want to show you. And it's a perfect chart for somebody like me because I'm not a Republican, I'm not a Democrat, but again, you see Republicans and Democrats on this chart. What you see are two things. You see the price of oil and you see the price of the US dollar. Now, what you'll note very quickly is that Ronald Reagan and Bill Clinton had something very, very similar in common, which is, of course, a strong dollar. They also had the price of oil under $20. Under $20 oil, you had very low inflation, you had real consumption growth occurring, in a way that this country's really never seen in a very long time. Then you bring along Bush and Obama, who have one thing in common, very much like Nixon and Carter had in common in the 1970s. They empower one guy, this guy, Ben Bernanke. They empower Ben Bernanke to effectively devalue the dollar, monetize the debt, create a fear-mongering situation that creates a very, very high level of anxiety in terms of people's confidence intervals in this country. It's a really 1970s kind of a makeup. And I think that that's why Obama's having some trouble with this, because he's supposed to be progressive. He's supposed to be positive. There's nothing positive about devaluing the currency. There's nothing positive about keeping interest rates, landlocked at zero. It just doesn't make sense. So if you want to have real economic growth, and this is the punchline, and it's a punchline, it's a story, it's reality. The point is that if you ever want to have real inflation adjusted economic growth, ever again, if you want to have growth, which I think a lot of people, politicians always say, what we need is a policy for growth. You know what the policy is? Get out of the way. Get Bernanke out of the way. Taper and let the market go to where the market is going. Let economic gravity occur. Let the dollar strengthen. Let interest rates rise. Let economic growth expectations rise. Let American confidence rise. So enough of this like rising above stuff. That is a total crock. Rising above as a country is done that way. Strong dollar, higher interest rates, and getting the Fed out of the way. That's my beef today. That's why I'm a little bit upset. I apologize for that. But again, if you have any questions about it, I know it's a long line of questioning that we could have on this. Hit me at my Hedgeye handle, which is, of course, at Keith McCullough. Any questions, compliments, or concerns, I'd love to hear from you.